Hello everyone and welcome to the episode of Let's Talk Mutual Funds. So basically this is a series in which we are going to talk about mutual funds, and this is going to be based on the book which I recently purchased, which is this one with the same name, and is a book by Monica Alban. So basically we are going to cover what are mutual funds, what are different types of mutual funds, and how to invest in them wisely for better returns. So with that in mind, let's start off with the video for the day. So the first thing that we need to understand is why should we learn about mutual funds, or why I'm personally learning about them. So when we are growing up, we don't talk about much about financial education at home or financial literacy. Our education system doesn't have much of the resources on how to manage your surplus income, or where to invest it wisely, or where to save money from taxes, or how to file taxes, or how to manage money wisely. Conversely, also in our day-to-day life in our family, we generally don't talk about money when we are young, because let's just say most of the expenses are taken care of the parents. And usually when parents get a little bit towards the retirement age and we start getting our new job, we are fresh out of college and we get a new job, but we don't know how to manage the money or where to invest the money. We blindly follow our friends advice or advices of people around us, and we just invest it in safer investment options, or the options which we feel are okay, or without going into deeply in them. This same thing happened with me. So I was investing like blindly anywhere that I felt like, but I didn't have a like quite a deep grasp of how it will be useful for me in the future. When it comes to money, we need that insights or deeper knowledge, because each of the decision that we make about investing money today is going to impact our future, or make it better or worse in the future. So that is why it is important to have financial literacy. And we typically see the ads like mutual funds sahi hai, and but we don't know कि mutual funds कैसे सही है, or how or where to invest in mutual funds itself. So that is the one question which I had since a long time. That is why I purchased this book from Amazon, and then I started reading it. And I decided that every week, whatever learnings I have from this book, I will share it with you all. So with that in mind, let's start off with mutual funds basics. We know that mutual funds money goes into stocks. So basically, stocks are the uh, main asset in which mutual funds invest their money. Now, let's just say if you want to directly trade in stocks, and let's just say if you purchase five stocks from the stock exchange, now it might happen that all those five stock will boom in the 5-10 years and you might get good returns. It might happen that those stocks might not work at all and you might go into loss, and it might happen that some of them might work, some of them won't. But we don't have that edge or necessary knowledge that we should have to invest in stocks wisely. Also, the people who are doing it full time have a slight competitive edge over us, because they are obviously doing it full time. We have a job and we don't have much time to understand the stocks in detail. And if you want to do it in the better capacity or in a better way, we need the time and as well as resources to understand them in detail. So what we do in that case? Now let's just say if you had an expert who knew about investing in stocks in a better manner, who has the knowledge, who has the skill set, and who has been doing it full time. And if you had that expert advice from a financial advisor who will be able to advise us of where to invest our money in stocks, and in that case, we will be able to make better financial decisions and get better returns from our investment in stocks. Now the thing that happens is the money that we generally invest in, let's just say monthly or annually into stocks, is like not much, but the fees that the financial advisor might charge might be a lot, and it might be even larger than what we actually plan to invest into stocks itself. So what do we do in that case? So this was a problem which was faced by a lot of people, and that is where what solution that a lot mediatory agencies came up with was, we can combine the money of different investors. Like let's just say if there are 100 investors and they each have 1,000 rupees, then those 100 investors will combine their 1,000 rupees, and then that combined stock pool will then be given to a financial advisor, and then financial advisor will charge some money out of that combined pool, and then invest the rest of the money into stocks. That way we don't have to pay the money the fees to financial advisor individually. We have better chances of returns, because we know that the financial advisor is well suited to handle the money into the stock markets, and we know that there is a trust that it will generate high returns in the future. That is the core idea of how mutual funds work. So basically you combine your capital, like you invest small amounts into a mutual fund company. The mutual fund company takes money from thousands of such or lakhs or even more than that in investors. It combines the pool of the money, takes that money and invests it into different kind of exchanges, not just stocks but also bonds and real estate and other commodities, and then use that money to give returns to you in exchange of some money or some servicing fee. So that is what mutual funds basically are. So basically you are taking the help of experts to invest your money into stock market. So mutual funds are basically vehicles by which you can invest money in a combined manner into stocks, bonds, gold, real estate, or a combination of all of them. Now when we talk about mutual funds, there are two concepts which we need to have a firm grasp on. The first is equity and second is debt. Now what is equity? So equity is basically the stocks which are listed on the stock exchange. So stocks of the listed and unlisted companies that are present in the stock exchange are basically what comprises of equity. Then there is debt. So debt comprises of FDs, PPF, government bonds, corporate deposits, and corporate bonds. So that is the main difference between equity and debt. Equity mainly like deals with the stocks which are on the stock exchange or of the unlisted companies as well. Debt typically deals with bonds and other kind of assets which can give us returns as well. Now when we talk about mutual funds, we generally just think of higher returns, and since they are giving higher returns we just invest in them. But there are other things that we should also consider. So there are other advantages of stock mutual funds than let's just say other means of investment. For example, if you are planning to invest in real estate, then the concept of liquidity comes into the play. So in case of real estate, if you buy a piece of land today and if you want to sell it in, let's just say, near future due to some emergency, it is quite hard to sell that land immediately, because you need to first find a buyer, then you need to negotiate the terms, then you need to follow a regulatory process, then legal processes, which takes a long time. So in terms of liquidity, investing in a real estate is not a good decision. But in contrast to that, if you are invested in the mutual funds and if you need some money in case of emergency, you can simply trade in that money back into the stock market, or trade that money from the mutual fund within 3-4 days, and you can get the money immediately. So liquidity is one advantage of having a mutual fund. Second thing is diversification. As I mentioned initially, that let's just say if you invest your entire money into 5 stocks and if they don't perform well, then you might be in a loss. If they perform well, that's a great thing. Now in case of mutual fund, what happens is the diversification happens and your money which is in equity gets spread across 60 to 70 stocks in general. So even if 5 or 10 of them don't perform well, the rest of them might, and based on that you will get returns. So your risk of investment goes down really a lot when you are investing into mutual funds. And another thing is, in terms of risk, the investment in mutual fund goes down as compared to stock markets. Obviously the returns that you get in stock market might be higher in some cases because you are investing in some specific companies, and if they perform well, you have a lottery, but that lottery comes at a risk. In case of mutual funds, you might not skyrocket your income like that, but you have an assured that it has a lesser risk but better amount of return which you can get, because your portfolio or your investment capital is divided across variety of stocks. Other than that, as I mentioned, that there is a financial advisor that you take and you give that money to them. So you might think that why should we trust an external agency to take our money and invest them? What if they take our money and run away? So government started an agency to look for all of the mutual funds that are present in the economy, and it introduced the Security and Exchange Board of India, SEBI in short. So this is the board which provides the rules and regulations which are necessary for mutual fund companies to follow, and these rules and regulations make sure that you have a trust into the various mutual fund management companies, and you have a trust that they don't run away with your money or don't perform any scams or fraud. So anytime if there is an irregularity, malpractice, scam or fraud that happens, SEBI immediately swings into action and it takes necessary actions to prevent that in the future and take corrective actions against the ones who do such malpractices. and it regularly releases new rules and regulations in interest of the investors. By this, what happens is the mutual funds become investor centric, and an investor centric market booms because the more trust people have into mutual funds, the more number of people are going to spread that knowledge with others, and more number of people are going to end up investing into the mutual fund economy or mutual fund overall capital. So that is the one thing that SEBI makes sure that you have a trust onto the mutual funds. Although there is risk involved of loss, but in general you have trust that okay, there is someone who is looking over all these companies which are managing your mutual funds or your investment amount. The next thing that we are going to cover is the structure of mutual fund companies. So whenever we talk about mutual funds, they typically consist of three elements. The first is sponsor, the second is trust, and third is asset management company. So sponsor is the one who sets up a business and who sets up a company which is called as asset management company, and asset management company are typically called as mutual funds. For example, SBI mutual fund is set up by SBI and Amundi of France. So they are the sponsors who set up the asset management companies or mutual fund management companies who look after the money and take decisions of where do should we invest the money of the investors into the stocks or other bonds and other stuff. The next thing is the trust. So there is a trustee or board of trustees who look after the money that investors invest. So this is the trust who will make sure that your money is managed well and it is kept safe. So this trustee have a personal stake, and SEBI has a guideline that they could be jailed if any kind of malpractices or scam is been done by the trustees. So the board of trustees look after the capital that the investor invests. The AMC takes that capital and invests into different stocks, securities, bonds, and other stuff. And based on the returns, we get the returns from the company. Now, the next thing is the choice of the mutual funds. So basically, there are more than 1200 mutual funds, and if you take the combinations which are possible in them, then it goes beyond 10,000. In that case, it becomes quite confusing as to where should we invest. So we generally go through the news and we just go through the apps and returns and we invest. But if we have a slight knowledge of how this mutual fund works, then we will have a better idea of where to invest and how to invest. So in that case, I'm just going to cover briefly about the types of mutual funds that are possible. Now mutual funds can be typically divided into three buckets, and these three buckets, or mainly I'm talking about equity based mutual funds. So the three buckets are large cap, mid cap, and small cap. So this large cap, mid cap, and small cap are basically related to stocks itself. So the stocks ranking from rank 1 to 100 into the stock exchange of India are called as large cap. Now what is large cap? So market cap is basically the number of stocks multiplied by the market price. The more number of shares that a company has and more the price it has, the more will be its market cap. And the market cap of such companies, like the companies which have the top 100 market cap in India, the largest companies which are present in stock market, they come under large cap. So basically, when you are investing into a large cap mutual fund, you are investing into the top 100 stocks which are present in the stock exchange. This gives us the stability and lesser risk, because we know that these companies have already established medium and the stock prices won't be volatile, and we'll get a fixed or a proper return to our investments. The next cap that is present is mid cap. So mid cap is the cap which is present from 101st to 250th company listed on the stock exchange. Now these companies are emerging companies and they have potential to become large cap. So their stock price is slightly lesser than the large cap companies, but there is a risk involved that they might not become large cap, or the stock price might not increase as much as we expect them to. So there is a larger risk involved. But if they in by any chance grow a lot, like they are in a growth stage, then the returns will be higher as compared to large cap. So a little bit higher risk, but a little bit more chances of profit or loss. So if you have a risk appetite, then the mid cap will be beneficial as well. And the last is the small cap. So from 251st rank onwards, all the companies that are present, they come under small cap. These are the quite emerging companies and early stage companies whose stock prices is less, so you are able to get more number of stocks in lesser amount, but you don't know whether they will perform well or not, or whether they will convert into a mid cap or a large cap company in future. So the risk involved is higher, but the returns obviously can be higher if they get into better position in future. So the three caps which I generally mentioned are large cap, mid cap and small cap, and on based on them we have large cap mutual funds, we have mid cap mutual funds, and we have small cap mutual funds. So these are the three main buckets. In addition to it, there are other buckets as well. For example, there is a flexi cap. So in case of flexi cap, what SEBI has guideline is 65% of the assets must be in equity, that is it must be in stocks. And there is another cap which is multi cap. In case of multi cap, your assets are distributed as such, like 25% should be in the large cap, 25% should be in the mid cap, and the rest of the 25% should be in the small cap. So 75% should be divided across the three caps. This gives you like diversification of your portfolio, and you are able to like gain a lot of edge or diversified portfolio, and you are able to invest well. So in that case, there is a multi cap involved. But in typical multi cap, 50% goes in large cap and rest 25 goes in small cap and mid cap. So that is the multi cap fund. Now where you should invest, that depends on your risk appetite and how you want returns to be. So these are the main caps which I have like understood till now. I will be covering more types of mutual funds, and I will also cover debt mutual funds in the future part of this video series. So in the episode 1, we briefly looked over what mutual funds are, how they work, what are the entities of the mutual funds, and the main three buckets which are present in the mutual fund. So I hope this video was useful. As I read this book, Let's Talk Mutual Funds by Monica Allen in detail, I will be able to gain much more insights and I will share them with you. Now this is not a promotional video, like I don't want to promote this book. I randomly came across this book on Amazon and I just wanted to read about mutual funds. But whatever insights I have, I will share it with you. So the goal of this video series is same, like I will be going through some books and learn some new things and share it with you. So this was the episode 1 of Let's Talk Mutual Fund. If you found this video useful, then hit the like button, subscribe to my channel and comment on how the video was, and if you have any feedback, please share it with me as well. And that's it from my end for today. And please subscribe so that I am motivated to share more such information in future. Thank you. Have a nice day. Goodbye.